Welcome all to Derivatives Learning Module 9, EOC Qs. Let's jump in. First up, we have South China Sprintwick Investments, SCSI. South China Sprintwick Investments, SCSI, has a Chinese equity portfolio that has outperformed in the first half of the year due to an overweight position in healthcare industry shares. SCSI is considering option-based alternatives China Well Inc. CWI. CWI has a current price S0 of 127.50 and pays no dividends. Current risk-free rate is 4%. We're just given RF as 4%. When I'm just told an RF of 4% like that, I'm going to apply it using compounding. That tends to be how they roll in the reading. You're a new SCSI analyst. I had to evaluate several alternatives for CWI stock. Here we go. Here's the first alternative. SCSI is considering the sale of a 3-month call on CWI shares. Now, I know this is not really what the question is asking, but let's just try and enjoy these questions and extract as much out of them as we can. Think about why they're doing this, the sale of a 3-month call. We are long the stock and we are selling call options. That is a hedge. As the value of the stock rises, the value of the call option will rise, and as we're short, that will eat into the value of our portfolio. So that is a hedge. If you observe a traded put price with the same underlying details, which of the following statements best describes how to derive the no arbitrage call price? Okay, so we've observed a traded put price. We want to get the no arb call price. How do you do that? It's put call parity. C0 plus PV of X, the present value of the strike, is equal to P0 plus S0. You've got to learn that. Now, we are being given a put. So we have the put. We are given the current price. So we have that. This only works if the strike is the same. We are then trying to isolate the call. So let's rearrange this formula. Just deduct PVX from both sides. You'd get C0 is P0 plus S0 minus the present value of the strike. So using put-call parity, how do you get the price of the call? This is the call. On the right-hand side, this is the synthetic call. These two situations, these two positions pay off the same. They must cost the same. So how do you get this call? On the right-hand side, you would have to go long on the corresponding put because the sign there is positive. You will go long on the underlying stock because the sign here is positive, minus PVX. You would be short on the bond. What does that mean? You would sell a bond. What does that mean? If you are selling a bond, you are borrowing. Let's see what the answers have to offer. Using put-call parity, the call price may be derived by subtracting the traded put price. Well, we're not subtracting because we're going long, so A is out. B, using put-call parity, the call price may be derived by adding the traded put price, yep, long put, to the underlying price, yep, long stock, less the present value of the exercise price minus PVX, yep. B looks right. C, using put-call parity, the call price may be derived by adding the traded put price, yep, to the present value of the exercise price. Note that needs deducting. C is out. Answer was B. Same scenario. Due to the recent sharp rise in CWI share price, SCSI is recommending that clients consider protective put strategies for 3 to 6 month tenors. Remember, protective put, we own the stock. So you are long on the underlying. You add in a long put position, the right to sell that stock. You know, if you own it up here, you put in a long put here, you've got the right to sell it at that price. It can fall this far, but you've got protection. That adds in a floor. If you observe that a 6 month CWI call option at an exercise price of CNY 120, so there's X, is trading at a price of 22.60, so that was a 6 month call. So the call is trading at 22.60. Which answer is closest to what you would expect to pay for a 6 month put with the same underlying terms? I've got to work out what a put is worth given the price of a call. It's put-call parity yet again. C0 plus PVX, the so-called fiduciary call, is P0 plus S0. Rearranging, I want to isolate the put. So deduct S0 from both sides. P0 would be C0 plus PVX minus S0. Do I have everything I need? The put would be C0. We were told it was trading at 22.60. Plus the present value of the strike. Strike is 120. PV at discount at the risk-free rate. We were just given 4%. So 1.04 to the power. It is 6 months. So half a year, 1.04 to the power half. Minus S0. Do we have S0? What's it trading at? Back in the scenario, CWI has a current price of 127.50 minus 127.50. Add that up, it's going to give you an implied put price of 12.769. Going to be C. You realize that the 6 month put option on CWI shares is overpriced. Ooh, exciting scenes. Relative to the no arbitrage price from question 2. We don't really need that price because we're not asked for numbers. We just need to know the actions we're going to take, the positions we take. Which of the following statements best describes the steps you would take to earn a riskless arbitrage profit under this scenario? It is once again put-call parity. C0 plus PVX is P0 plus S0. What's this telling us? The cost of this side is the same as the cost of this side. How do we know that? Because these two positions always pay off the same. If they pay off the same, they must cost the same. Rearranging, let's isolate the 6-month put, which is overpriced. So P0. How do we isolate? Let's knock off S0 from both sides. That would leave P0 on its own. Will be equal to C0 plus PVX minus S0. Here is the actual put. Here is the synthetic put. Now, what do we need to do to make arbitrage profits? We were told that these two are not equal because the 6-month put is overpriced. So actually, the price of the put is greater than the price of the synthetic. What do I want to do? Well, always sell the overpriced. So I'm going to sell the put. And I'm going to buy the synthetic. How do I buy this? If I'm buying, I just follow the signs. Plus, plus, minus. So I go long on a call because it's positive. I will go long on the bond because it's positive. Long on the bond means investing, lending. I'm buying a bond and giving somebody money. Minus S0, I'm going short on the underlying stock. Let's see if any of the answers tie into those. A, sell the 6-month put option. Sell the put, yep. Sell CWI short, short the stock, yep. Invest the proceeds in a call option, long call, yep. And a risk-free bond, buy a bond, invest in a risk-free bond, yep. It's A, looks good. B, sell the 6-month put option, yep. Buy a call option, yep. Borrow at the risk-free rate, no. We are investing in a bond. Buy shares, no. C, sell the 6-month put, yep. Buy a call option, yep. Enter a forward purchase of CWI. No, we want to short the stock, so no. Invest in a risk-free bond, yep. Those two are wrong, it is A. In her most recent research note on CWI, SCSI's equity analyst specifically mentions an increase in CWI's leverage ratio as a reason for her bearish outlook on the stock. So an increase in the leverage ratio, that would increase financial risk. She's thinking that means a bearish outlook for the stock. Checks out. Applying the put-call parity relationship to the value of the firm. How do we do that? Put-call parity we know and love. C0 plus PVX is S0 plus P0. We're going to use the value of the firm. So the underlying here, instead of being a stock, the underlying is the value of the firm. The strike price, we're going to put in as the face value of debt. And then we'll have a put option and a call option on the value of the firm with a strike price of the face value of debt. Now, if we rearrange that to isolate the value of the firm, V0, knock off the put from both sides, that leaves us with the call option plus the present value of the face value of debt minus P0. We are breaking down the value of the firm into a call option. That is effectively the position of the shareholders. And the present value of the face value of debt minus a put option on the firm value. That is the position of the debt holders. Now, what's happened here? Increase in the leverage ratio gave us a bearish outlook on the stock. Shareholders have effectively gone long on a put option to sell the asset to the firm at the face value of debt. They've sold that to debt holders. The debt holders you can see in here are short that put option. Now, what's happening as leverage goes up, financial risk goes up, the likelihood of being insolvent or becoming insolvent increases. that will increase the value of this put option. Given this is a negative, that will worsen the position of debt holders. So let's take a look. What are the options? Which most accurately describes A, the shareholder payoff has improved versus debt holders because they have sold a put option on firm value? No. Shareholders have a put option on the company's assets. They haven't sold it. It's the debt holders who've sold it. So A is wrong. B, the debt holder payoff has deteriorated versus the shareholders. Yes, I think it has, because the value of that put that they are short on has increased. Because they are effectively short a put option on the value of the firm. Yes. Equal to the value of debt. Yep, that's the strike. Which has appreciated in value. Yes, it has. B looks good. C, the shareholder payoff has improved versus the debt holders because the debt holders have sold a call option on the firm's assets to the shareholders. Well, the shareholders do effectively have a position analogous to a call option on assets, but it's not been sold to them by the debt holders. So C is wrong on that count. It has to be B. Which of the following choices best describes how SCSI could replicate a long risk-free bond using a forward contract on CWI and call and put options on CWI? This is old friend, put call parity again. C0 plus PVX is equal to P0 plus S0. Only twist, we've introduced a forward contract. Instead of the underlying S0, they want us to put in there a forward contract. Easy enough. Remember our very basic pricing of a forward contract. We said your forward price is your spot into 1 plus R to the T. Now, if we rearrange this formula, we can easily say that S0 is the forward price divided by 1 plus R to the T, or just to write it quickly, the present value of the forward price. So let's substitute. Let's rewrite this as C0 plus PVX plus equals rather P0 plus not S0, but the equivalent of S0, which is the present value of the forward price. Now what have we got to do? Replicate a long risk-free bond. So we want to isolate this PVX. To do that, let's deduct C0 from both sides. That would leave us with PVX here. P0 plus the present value of the forward price minus C0. Which does that tie into? A, short a forward contract on CWI. No, it's plus. B, longer forward contract, it's plus. Longer put option, that's a positive. And short a call option, that's a negative, that's a short. Answer is B. C, longer forward, that would work. Longer put option, that would work. And longer call, no, that would be negative. C is wrong. SCSI observes that a 3-month call option on CWI with an exercise price of 130, so X is 130. T, 3 months is 3/12, so 0.25. Trades at premium of CNY 3, so C0 is 3. A 3-month forward contract on CWI trades at a forward price of CNY 128.76, so we've got the forward price, 128.76. Which of the following choices is closest to the correct premium for a 3-month put option with an exercise price of CNY 130. So same expiry, same exercise price, we're going to use put call parity. Now, to be fair, they've thrown a forward contract in here, so I think their aim is to say, oh, let's make sure you have to do a question using forward put call parity. But we've also got the underlying, so there's absolutely no need to do that. If you're more comfortable with the basic form of put call parity, let's just do that. Why get involved with forwards? C0 plus PVX plus equals P0 plus S0. We are looking to calculate the correct premium for the put. Let's isolate the put, so we knock off S0 from both sides. Would leave us C0 plus PVX minus S0. Correct price is therefore the call premium of 3. PVX, strike is 130. Discount it at the risk-free rate, just given 4%, so I'm going to use it to the power, 0.25, 3 months. Minus S0, 127.50. That will give us a correct price for the put of 423. 423 is closest to A. Now, if you don't believe me and think, oh, hang on, Richie, they wanted us to use the forward, we should use the forward. Okay, then. If you use the forward, it is C0 plus the PV of the strike. It's looking very similar so far. Minus, you replace S0 with the PV of the forward. So the forward price is 128.76, discounted at 1.04 to the 0.25. And just before you go anywhere else, just calculate that term. 128.76 divided by 1.04 to the power 0.25. Lo and behold, it's 127.50. You're going to get the same answer. So no need to go via the forward. I guess it's a nice demonstration of why, or how rather, to derive the put call parity formula using a forward contract. But either way, 423 closest to A.